Good morning, everybody. Good morning and happy Monday to all you magnificent melon heads out there. The weekend is over, a new week is upon us, and it's looking like it's going to be a big one. A lot going on this morning. First of all, Ashford Trust, in a Friday afternoon news dump that I'm sure the company was hoping nobody would notice. You never release your best news Friday afternoon after the bell. It's always the bad stuff that comes out. Ashford Real Estate Investment Trust announced that they are consensually ending the relationship on 19 hotels. There's a mortgage pool of $982 million that the company has said, you know what, we don't like these hotels so much anymore. We're just not going to pay for them anymore. Good luck to the banks. They're yours now. This is a trend that we have seen over and over again across the country. It's only just getting started. This is the commercial real estate bubble bursting. It is in progress. We're watching the early innings of it. And that's important because we are starting bank earnings this week. Friday afternoon, we get the first few banks, JP Morgan, and I believe Citi is the other one that reports Friday afternoon. But it's not the big banks that you need to be worried about. It's the little banks and the medium banks. They're the ones to watch out for. Because remember that whole big mess from March and April and May, First Republic, Silicon Valley, Signature, Silvergate, Credit Suisse, all those? That problem never went away, guys. The Fed injected a little bit of liquidity. They created the Bank Term Funding Program. There was a lot of loans. There were some mergers. But that problem, the underlying weaknesses in the bank system, that never went away. Losses, unrealized losses from securities, namely bonds, U.S. Treasuries. That was what drove those bank failures. Well, interest rates have only gone higher ever since that crisis. Higher interest rates means lower bond prices, which means the underlying problem that caused those bank failures has only gotten worse since March. On top of that, this commercial real estate problem now, that affects mostly the regional banks. Because what is it? About 80% of commercial mortgage-backed securities and commercial real estate debt in the United States is on the balance sheets, not of the big giant JP Morgans. No, it's the little bitty First Republics that have all of those commercial real estate loans on their books. So the very banks that are right now teetering on the brink, they're the ones most vulnerable to this commercial real estate problem that is only just now starting. So that starts later this week. We've also got Consumer Price Index and Producer Price Index, CPI and PPI, come out this week. What else we have going on? We talked about the banks. China had their CPI came out recently. CPI in China, 0.0% year over year. No inflation in China. Producer Pricing Index came out in China, negative 5.4%. Deflation in the world's factory. I've been saying deflation is coming for a while on this channel. It hasn't been the best received message. A lot of people, they're still struggling with the increase in the cost of living for the last few years. So it's hard for those people to really grasp that deflation could be coming because they live in a world that has still been flipped upside down by previous inflation. But there it is, folks. Negative 5.4% producer price index in China. China makes all the stuff that we buy. It's getting cheaper to make the stuff. That is downward pressure on prices. China is suffering from a massive consumer slowdown, from banks tightening lending, and they're also still on the brink of their own property bubble collapsing. So deflation, not a good thing in China, not in a country that is heavily indebted. Keep in mind, they've got trillions upon trillions of real estate debt in China, and in deflation, debt gets harder to service. So that could be a big problem on the rise in China. And Disney. Pay attention to what's going on in Disney World. Remember last week I talked about how the 4th of July was one of the busiest 4th of Julys in history. I think it was the Friday before the 4th was the single busiest day at TSA checkpoints in history. More people traveled than ever before. It was, I think, 2.88 million people were screened by the TSA on that Friday before the 4th of July weekend. I don't know where they were going, but they sure as heck were not going to Disney World because the wait times in Disney World are way down. The 4th of July was the third slowest day for wait times in Disney World all year long. So even as travel is ramping up in the United States, theme parks are struggling and hotels are going belly up. What does that tell you guys? Things are not as rosy as you hear on some of the other finance networks. And with that, I have to say thank you so much to the sponsor of today's live stream, the Patriot Gold Group. Guys, when we're talking about banking problems, resurfacing, and regional bank crisis and losses from bonds and commercial real estate bubble, you know what? What does the market do? What does the smart money do when crises emerge? They go to safety. You see a flight to safety. You see a stampede down Exeter's pyramid. And what is at the very bottom of Exeter's pyramid? What is the safest asset you could possibly own? Physical precious metals like gold and silver, where there is zero counterparty risk. And that's why I am a proud client of the Patriot Gold Group. I just bought some gold and silver from them last week. Patriot Gold Group is a top-rated gold and silver-backed IRA dealer for 7 years in a row. So go to nsfgold.com. There's a link down below in the description, or call that number up on the top of the screen there, 888-988-5401. Get your free investor's guide, and as always, tell them that nobody sent you. And with that, let's shrink my big melon of a head and see what's going on in markets this morning. And just want to point out the Fear and Greed Index. This is CNN's Fear Greed Index. It's based on moving averages. It's based on stock market breadth. Still in extreme greed territory at 78. This thing has been over 70 for more than a month. This market is still top heavy and prone to a correction. But right now, it's not happening. The S&P is actually up 8 points, or 0.17% right now at 4,406. The Dow is up 80 points, or 0.24%. It was in negative territory for a while there this morning, hence the bear icon. But it looks like we're getting a bounce at the open. The Dow is trading at 33,814. And the NASDAQ is the sole negative index right now, down 3 points, or just 0.03%, trading at 13,656. Looks like the U.S. dollar, it was up sharply this morning, giving back all of that just after the opening bell. DXY currently heading lower, but still up 12 basis points, or 0.11%, at 102.39. Looking over at the bond market, we got a mixed bag today. The 10-year, the all-important one, that is down not quite 1 basis point at 4.04. We've got the 2-year yielding 4.92. That's down 1 basis point. And the 1 month is basically unchanged at 5.26%. Keep an eye on that 10-year yield, guys. It's currently over 4%. It's been kind of range-bound the last couple of days here. Let's bring up this chart here. Let me show you a 1-month chart of the 10-year. We're kind of still at the upper end of the band it's been trading at. Yields have been moving sharply higher ever since the debt ceiling was suspended and Janet Yellen went on her borrowing bender. So keep an eye on this one. Bad things tend to happen over 4%. Remember, we were at 4.15, 4.2 back in December, and, well, a few months later, banks started failing. So keep an eye on this one. Rates just continue to go higher. Let's look in commodities. We've got gold is down $5.50 today at $19.26, down about 0.3%. Silver is down 8 cents, or 0.4%, at $23.19. Crude oil is having it's had a heck of a run. It's down a little bit right now. Currently at $73.44, down 40 cents on the day. But crude has gotten a pretty nice bounce out of the low 60s. We'll see if that one holds. There's plenty going on with the OPEC countries cutting production, but at the same time, global demand is slowing. Which one of those forces will prevail? Right now, it looks like the production cuts are prevailing, but we'll see if demand falls further. And natural gas, we've got up 7 cents, or 2.83% today at $2.65. But here is the big story I want to talk about. This one came out Friday afternoon. Hotel REIT says it will likely return 19 properties to lenders. And if it's in the press and they're saying they're likely, it means they're already doing it. It just hasn't officially happened. The Ashford Trust also extended debt on another group of hotels. Properties would have required a paydown of $255 million. Ashford Hospitality Trust expects to return 19 hotels to lenders in cities including Las Vegas and Atlanta, declining to pour more cash into properties, which are part of a $982 million mortgage pool that missed a repayment deadline in June. So this pool of mortgages, almost $1 billion, $982 million, representing 19 different hotels. They were supposed to be paid back in June. They did not make that payment. And now Ashford is saying, you know what, we're walking away. We're not going to make the payments anymore. We're not going to pay back the bill. Here is the hotels. Good luck, banks. Now, keeping the hotels would have required a pay down of about $255 million to extend financing, plus $80 million in capital expenditures through 2025. So what was going on is the lenders were saying, hey, we know these properties have gone down in value. We know rates have gone up. So in order for us to refinance your loan, you're going to have to write us a check for $255 million. Basically, you have to pay down a quarter of the loan, and then we'll refinance what's left of that principal for another few years. And then the banks were looking at that, and they said, well, we're going to have to spend about $80 million to either for upgrades or new furniture, whatever these hotels needed. They said, it's just not worth it. We're walking away. No more payments. Here's the keys. At this time, it appears that the most likely outcome will be a consensual transfer of these hotels to the respective lenders. I love that line. It will be a consensual transfer of these hotels to the lenders. It's kind of like the guy who just got dumped who said, oh no, it was a mutual thing. We both decided we just wanted to be friends. No, you got dumped. There's nothing consensual about this. These hotels are getting dumped on the banks. The banks don't want them. It's just in the contract that the lender can, or that the buyer can walk away at any time. So I love that line, that this was a consensual transfer. It was a mutual thing. No, she dumped you. All right, looking over here at CNBC, this is why you need to worry about that story about the hotel REIT. The American banking landscape is on the cusp of a seismic shift. Expect more pain to come. Now, this is in CNBC, which tends to toe the party line of the financial system, so keep that in mind. If they're talking about trouble in the regional banking system right now, it means they're worried about it because CNBC is the first one to put in big, bold letters, Janet Yellen says banks strong and resilient. All right, this is not a FUD network is what I'm trying to tell you. So if they're talking about this, it means they know they can't sweep this story under the rug. Rising interest rates, losses on commercial real estate, and heightened regulatory scrutiny will pressure mid-sized banks, leading to a wave of mergers, sources told CNBC. Some of those pressures will be visible as regional banks disclose second quarter results this month. Firms including Zions and KeyCorp have already warned of sinking revenues. So we've got regional banks. The banks start reporting on Friday, but it's not the big banks. It's not JP Morgan. It's not Wells Fargo. Although those banks will probably report lousy quarters, they're probably going to set aside a lot of loan loss provisions, which is going to come right out of their earnings. Although some of them are probably going to try to offset that by increasing their dividends because they just passed the stress test, and which was a joke of an exercise and it was largely scripted. But they'll probably raise their dividends to try to blunt the trauma of those lousy numbers they're about to report. But it's not the big banks that you need to worry about. It's the little guys. It's the medium guys. They're the ones that are most vulnerable. They're already wounded because of what happened in the spring when Signature and Silicon Valley went down. They've already had a run on deposits, and they've already taken a lot of losses. They've already moved all of their assets for sale over to held to maturity, which is just an accounting gimmick that makes their balance sheets look better than they really are. But now you've got the problem of commercial real estate on top of that, and it only takes one bank warning. All right, it only takes one bank to come in and say, we lost 20% of our deposits and we are grotesquely exposed to commercial real estate and we're expecting to lose more. And then that bank stock plummets. Seeing the bank stock plummets, the depositors start pulling their money. It only takes one domino to start this whole mess up again. And we're heading into earnings season where they have to report this kind of stuff. So I'm not saying it's definitely going to happen, but the conditions are ripe for a rekindling of the fears of the regional banks that we saw in the spring. Half of the country's banks will likely be swallowed by competitors in the next decade, according to Fitch analyst Chris Wolf. That's big there, folks. Half of the country's banks will likely get swallowed up because really that's the only defense for these regional banks when they go insolvent is to be bought up by one of the big banks. In other words, more consolidation in the banking sector. Now, there's something like 4,800 banks in the country right now. There used to be over 8,000 banks in the country before the GFC. So currently we're at 4,000 and change, down from 8,000 and change. And this article is saying we're probably heading to 2,000 and change. That's over several years. More and more consolidation in the banking system, fewer banks, more control, more centralization, and all the good, bad, and ugly that comes along with that. And I wanted to point out this story also, guys. Keep an eye on this story because there is a lot coming out of China lately, a lot of news. China slides to brink of deflation, adding stimulus urgency. The CPI was 0% year over year in June. That is the lowest rate in more than 2 years. And producer price deflation deepens to the worst since December of 2015. December of 2015 was the last time there was a stock market crisis in China. China's consumer inflation rate was flat in June, while factory gate prices fell further. fueling concerns about deflation risks and adding to speculation about potential economic stimulus. Everybody is waiting for the PBOC, that's the People's Bank of China, their Fed. Everybody is waiting for them to go burr to try to rekindle inflation because debtor countries cannot have deflation. The Consumer Price Index was unchanged last month from a year earlier, according to data released by the National Bureau of Statistics on Monday. That was the weakest rate since February of 2021 when slumping pork costs dragged on the index. Core inflation, which excludes volatile food and energy costs, slowed to 0.4 from 0.6. And this is big here. Producer prices fell 5.4% from a year earlier, the deepest pace since 2015. That's deflation, guys. Producer prices falling. Sooner or later, that's going to translate into consumer prices falling. The risk of deflation is very real, said someone I can't pronounce, the chief economist at Pinpoint Asset Management. Deflation is coming in China, and that's the world's factory. Pay attention to that story. And last one, but not least one today, Disney World hasn't felt this empty in years. Shorter wait times for rides and more discount offers are signs of thinning crowds at theme parks. And it's amazing that we're having this conversation because think about some of the headlines that we've talked about in recent days, guys. We talked about the busiest travel day in history in the United States, and here we are a week later talking about defaults on hotels, and the biggest theme park in the world is empty. These two stories don't seem to jive with each other, do they? Yet there it is. Shorter wait times at Disney World. Visitors to Disney theme parks this summer are encountering something they haven't seen in a while: elbow room. Travel analysts and advisors say traffic to Disney's U.S. parks and some rival parks has slowed this summer. Data from a travel company that tracks line waiting times at Walt Disney World in Orlando, Florida, shows that the Independence Day weekend was one of the slowest in nearly a decade. Disney executives have said they have expected weaker earnings from their U.S. parks this year. The Orlando area resort is even offering hotel discounts around Christmas, typically a peak period. Travel advisors and industry analysts say the slowdown is the latest sign that Disney's recent price hikes and changes to park operations have soured some families on visiting the most magical place on earth. That is kind speak for saying Disney's culture war may be costing them business, and the fact that they just raise prices relentlessly is pricing people out. I'm sure both are playing a role here. Disney faces a unique set of challenges right now, from streaming losses to executive succession to a political and legal fight with Florida Governor Ron DeSantis. Revenue from its parks division has long been a bright spot for the company, buoying overall earnings, but Disney declined to comment on recent attendance. And check out some of these numbers here. There's data behind this. At Disney's Hollywood Studios theme park in Central Florida, home to blockbuster Star Wars attractions, July 4th was the third slowest day in the past year. That is, the record-setting July 4th was the slowest day in the past year, the third slowest day in the past year. So all these people who are traveling, they're not going to Disney World. And this is according to Touring Plans, which analyzes wait times that Disney parks post on their mobile apps. The average posted wait time at the Magic Kingdom Park in Florida, which was a special fireworks display on July 4th, that was 27 minutes this year for the holiday. That's down from 31 minutes in 2022 and 47 minutes in 2019. So shorter lines means less people in the park. So whatever's going on in the world of travel, they're not staying at those Ashford hotels, and they sure as heck are not going to Disney World. And guys, that is about all I got for you today. I want to say thank you so much to everybody for watching. Thank you for your time. Thank you to my Patreon supporters for everything you guys do for the channel. Link down below should you feel so inclined. Thank you to Patriot Gold for the sponsorship of this live stream. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.